Welcome to the ASC 710 Compensation Complete Series Recap. This video summarizes all 7 sections of the training series, covering the general compensation framework, compensated absences, vacation liability measurement, sabbatical and termination benefits, deferred compensation and rabbi trusts, journal entries and presentation, and audit controls and compliance. Use this recap as a consolidated review before assessments or as a quick reference refresher. This recap covers all 7 sections. Section 1 introduced the general framework and scope of a SC 710. Section 2 covered the 4 criteria that determine whether to accrue compensated absences. Section 3 explained how to measure the vacation liability. Section 4 covered sabbatical leave and termination benefits. Section 5 addressed deferred compensation and rabbi trusts. Section 6 brought together the journal entries and balance sheet presentation rules. Section 7 covered audit procedures, internal controls, and the period-end compliance checklist. In Section 1, we established what a SC 710 covers. It addresses 2 primary areas: compensated absences, including vacation and sick leave, and deferred compensation arrangements. It does not apply to pensions, which are governed by a SC 715, or to stock-based compensation under a SC 718. The core principle is the matching principle. Recognize compensation expense in the period the employee earns the benefit, not when the employer pays it. The key terms from Section 1 are the 3 types of absences. A vesting absence is one where the employee retains the right to payment even if employment ends. A non-vesting absence is forfeited when the employee leaves. An accumulating absence is one where unused time carries forward. And deferred compensation is an arrangement where an employee defers receiving current pay to a future date, such as retirement. The matching principle, which is the foundation of all a SC 710 accounting, requires that compensation expense be recognized in the same period the employee renders the service, not when the employer writes the check. Underaccrual overstates profit and understates liabilities. Overaccrual understates profit and overstates liabilities. Either misstatement distorts the financial picture presented to lenders, investors, and other users of the financial statements. Section 2 introduced the 4 criteria for compensated absence accrual. All 4 must be satisfied simultaneously. The first criterion is that the right to the absence is earned through past service. The second is that the right either vests or accumulates. The third is that payment is probable. The fourth is that the amount can be reasonably estimated. If any single criterion fails, no accrual is required regardless of whether the others are met. The practical application of the 4 criteria in Section 2 showed that vacation almost always satisfies all 4 criteria and therefore always requires accrual. Sick leave, however, usually fails criterion 2 because most sick leave policies do not vest and are forfeited when employment ends. The exception is when a company's policy or applicable state law requires unused sick leave to be paid out on termination or to accumulate indefinitely. When that is the case, all 4 criteria are met and accrual becomes mandatory. Section 3 covered how to measure the vacation liability. The measurement is based on the expected pay rate at which the time will actually be settled, not necessarily the current rate. Employer payroll taxes, including the employer's share of FICA, must be included in the measurement. The gross liability is then reduced by expected forfeitures based on historical experience. The calculation must be updated at every period end as balances and pay rates change. The 4-step vacation liability calculation from Section 3 starts with identifying the hours or days accrued by each employee. Those hours are then multiplied by the expected pay rate at which they will be settled. Employer payroll taxes are added to the total. Finally, the estimated forfeiture amount is subtracted to arrive at the net liability. This calculation should be applied to every employee individually or using population-level estimates supported by historical data. Section 4 covered sabbatical leave accounting. The key question is whether the sabbatical serves the employee as a rest and recuperation benefit, or whether the employee is expected to perform duties that benefit the employer during the leave period. If the sabbatical is purely for rest, it is attributable to past service and must be accrued over the qualifying service period, similar to vacation. If the employee continues to work for the employer's benefit during the sabbatical, the cost is not attributable to past service and should be expensed when the sabbatical actually occurs. Also from Section 4, termination benefits fall into two categories. Voluntary termination benefits under a ASC 710 are recognized when the employee accepts the offer, not when it is announced. Involuntary termination benefits under a ASC 420 are recognized only when all four ASC 420 criteria are satisfied, which requires the plan to be communicated to employees in sufficient detail. Recording a restructuring reserve before all four criteria are met is one of the most common audit findings in compensation accounting. The four ASC 420 criteria from Section 4 are the mandatory conditions for recognizing an involuntary termination liability. First, management must have approved a plan specifying the benefits. Second, the plan must identify the employees, job functions, and locations affected. Third, the plan must be unlikely to change significantly before implementation. Fourth, and most importantly, the plan must have been communicated to the affected employees in enough detail for them to understand the benefits they will receive. All four must be documented simultaneously. Section 5 covered deferred compensation. An employee defers receiving current pay to a future date, most commonly retirement. The employer recognizes the obligation over the service period during which the deferred benefit is earned. Each period, the entry is a debit to deferred compensation expense and a credit to deferred compensation liability. When the employee eventually retires and receives the deferred amount, the entry is a debit to the liability and a credit to cash, with no additional expense at payout because the cost was already fully recognized. Also from Section 5, the rabbi trust is a funding vehicle where the employer sets aside assets to meet the deferred compensation obligation. The defining feature of a rabbi trust is that the assets remain subject to the claims of the employer's general creditors in the event of insolvency. Because of this creditor exposure, the trust assets stay on the employer's balance sheet rather than being removed. The deferred compensation liability also stays on the balance sheet. The two must be presented gross, meaning they cannot be offset against each other. Section 6 consolidated the journal entries across all compensation categories. For vacation accrual, the entry is a debit to vacation expense and a credit to accrued vacation liability. When the employee takes vacation or receives a payout, the entry is a debit to the liability and a credit to cash. For deferred compensation, the period accrual is a debit to deferred compensation expense and a credit to deferred compensation liability. When the employer funds the rabbi trust, the entry is a debit to rabbi trust assets and a credit to cash. Also from Section 6, for voluntary termination benefits, the entry is a debit to termination benefit expense and a credit to termination benefit payable on the date the employee accepts. For involuntary termination benefits, the entry is a debit to restructuring expense and a credit to restructuring liability, but only after all four ASC 420 criteria are documented. In both cases, settlement is simply a debit to the liability and a credit to cash, with no additional expense at payment. The balance sheet classification rules from Section 6 require each liability to be classified based on the expected settlement date. The vacation liability is almost always current because employees typically take their time off or receive payouts within a year. Deferred compensation liabilities and the corresponding rabbi trust assets are usually classified as non-current because they are tied to retirement. Restructuring liabilities should be split between current and non-current based on the actual plan payment schedule for individual severance amounts. Section 7 covered the key audit risks across all categories. For vacation, the risks are incomplete balances, wrong pay rates, and omitted payroll taxes. For deferred compensation, the risks are accrual in the wrong period, netting the rabbi trust asset and liability, and incomplete disclosures. For termination benefits, the main risk is recognizing the liability before all 4 ASC 420 criteria are met. Across all categories, incorrect classification of liabilities between current and non-current is a common finding. The key internal controls from Section 7 include a monthly reconciliation of HR vacation balances to the payroll system to catch shortfalls before period end. For deferred compensation, an annual review of plan documents and a documented allocation method memo are essential controls. For termination benefits, a formal checklist confirming all 4 ASC 420 criteria are satisfied before recording any charge is the most important preventive control. All material compensation accruals should require sign-off from a manager or controller before the period is closed. The period-end compliance checklist from Section 7 covers all 4 areas. For vacation, reconcile balances, update pay rates, and confirm payroll taxes are included. For deferred compensation, confirm plan terms have not changed, compute the current period accrual, and update the fair value of rabbi trust investments. For termination benefits, confirm all ASC 420 criteria are documented before booking and update the liability to reflect actual payments made. And for all categories, update the note disclosures to reflect current amounts and any changes from the prior period. As a quick reference, here are the 4 most common mistakes seen in practice. First, accruing sick leave that fails Criterion 2 because it is forfeited on termination. Do not accrue when Criterion 2 fails. Second, using the current pay rate instead of the expected future rate for vacation measurement. Third, netting the rabbi trust asset against the deferred compensation liability instead of showing them gross. And fourth, booking a restructuring reserve before the termination plan has been communicated to employees. Avoiding these 4 mistakes eliminates the majority of ASC 710 audit findings. Apply this decision tree at every period end for each absence type. Ask first whether the benefit is earned by past service. If not, stop and do not accrue. Ask whether the benefit vests or accumulates. If not, stop. Ask whether payment is probable. If not, stop. Ask whether the amount can be reasonably estimated. If not, disclose a contingency under ASC 450 but do not accrue. Only when all 4 questions are answered yes should a liability be recorded. This 4-question test is the most practical tool in ASC 710 compliance. As a quick reference map, vacation and sick leave fall under ASC 710. Deferred compensation and rabbi trusts also fall under ASC 710. Pension and post-retirement benefit obligations are governed by ASC 715 and have their own complex measurement rules. Stock options, restricted stock units, and employee stock purchase plans are governed by ASC 718. Involuntary termination benefits arising from restructuring or exit activities are governed by ASC 420, not ASC 710. Always confirm which standard applies before recording an entry. For your reference, here is the full set of journal entries from the training series. Vacation earned, Debit vacation expense, credit accrued vacation liability. Vacation used or paid out, debit accrued vacation liability, credit cash. Deferred compensation period accrual, debit deferred compensation expense, credit deferred compensation liability. Rabbi trust funding, debit rabbi trust assets, credit cash. For termination benefits, debit the appropriate expense account and credit the liability account at the correct recognition trigger, which is employee acceptance for voluntary benefits, and all 4 ASC 420 criteria met for involuntary benefits. Bringing together the overall key takeaways from all 7 sections of the ASC 710 training series. Recognize all compensation expense in the period it is earned through service, not when it is paid. Apply the 4 criteria test to each absence type separately because different policies lead to different conclusions. For rabbi trusts, always use gross presentation with both the asset and the liability on the balance sheet, and never net them. For termination benefits, timing depends on whether the benefit is voluntary or involuntary, and the correct recognition trigger must be applied. And strong internal controls combined with monthly reconciliations will prevent the vast majority of audit findings. Thank you for completing the full ASC 710 compensation training series.